Hello, everyone. It's time for our last talk of the day. So thank you for those of us that have been here all afternoon. We've had a fantastic set of speakers from really inspiring startups. And so this is the last time that I'll be chatting with you. And the last talk of the day is an appropriate way to end the conversation, which is to talk about the innovations across fintech and what's coming next. So discover the latest in pay tech and explore the transformative innovations shaping the industry, including real-time payments, BNPL, super apps, and embedded finance. Please welcome to the stage Ralph Germer, co-founder and CEO of PagBrasil, Ángel Peña, co-founder and CEO of APLAZO, and Camila Vieira, partner at QED Investors. And they're in conversation with Olga Maslikova, founder and host at the J-Curve.
So I was super excited about this panel because normally when you hear about Latin America, you hear crisis, currency devaluations, volatility, all this stuff. But when things relate to financial services and fintech, this is where the region, and Brazil in particular, not only catching up, but leading the world and creates global examples in terms of how financial services should be done. You see Nubank becoming the most valuable digital banks. You see Mercado Libre continuing to grow at over 30%, partly due to Mercado Pago, due to its fintech arm. We see Brazil going from all cash to digital economy, thanks to the government regulatory body policy. But I'm curious, where do we all gonna go from here? And I actually want to start with Camila. And you see the entire region from the global investors' perspective, and you backed some of the iconic companies, including Nubank and Creditas here in the region. If we zoom out for a second, where do you see the biggest white space that exists today in the region? And what are the kinds of companies that you are backing or consider backing today that a few years ago, maybe they were too small, or maybe they were too, hard to build?
Yeah, so to start, QED does focus globally, but we do have a quite large representation in LATAM. And we do have to say Mexico and Colombia look very different than Brazil. PIX came to change everything, right? So in Brazil, the expectation when you make a payment looks in some certain way. As a business, you're still paying duplicatas, you're still very much doing manual work if you're not 100% a digital business. In Mexico, the offline options look way different than the offline experience in Brazil. So it's very hard to compare them, but for us, where we look next is for Brazil, both on the consumer side and the infrastructure side, who's really going to take the loyalty of the business. So if you're going to have 4 maquininhas, if you're going to be able to pay PIX recurring and Boleto is going to die, regardless of where we kind of end up as an ecosystem, that business, where is that TPV going to go through? What's going to be the choice? So we look through a lot of reality, trust, loyalty, and that isn't too dissimilar to what we look in Mexico, right? Like we hear in Brazil a lot of how fast, how cheap, how integrated the solution is. In Mexico, we talk a lot about trust. Really, what is driving trust? What is driving sales? And how can you differentiate from other solutions that may very much be the pencil saying, I sold to X person, and that person's going to pay me 3 months from now. So I think for us, it looks very different on the countries, but for Brazil specifically, we've been looking at the industries that 3 years ago was very hard to consolidate. And we can talk about lawyers, we can talk about dentists, healthcare as general, but even some SMEs in tier 2 or 3 cities that was extremely difficult for a digital business to reach. I think now is the time where they're using Pix, they've understood Pix, they're understanding that now buy now pay later solutions are getting to those cities. So we've been trying to focus on what hasn't been done and focusing on payments as the enabler for that to happen, of course mixed with AI and other fintech solutions. For Mexico, I think we still have to see a jump in digitalization, but the trust in players that can do both online and offline, I think it's kind of one way to educate the companies and consumers how to get it done, where in Brazil, you don't really need to do a lot of education. You actually have to just deliver to very high expectation. So different moments, but very excited for both countries.
I love that.
May I jump in quickly on this? I think in Brazil, we are in a very special situation now because 93% of all payments are already digital, so only 7%, a very small fraction is still in cash happening. And this changes the whole, there's like a tipping point because in the whole world, fintech companies and banks and payments companies were growing by replacing cash. There was like a huge potential of growth, and this is gone. So the only way a company in Brazil can grow now is by innovating, by creating like amazing new technology, or they are out of business or they will simply not grow anymore. And so here we are talking not anymore about how replacing cash, but what we can build on all this digital infrastructure, payments infrastructure that was created until today.
So I want to go deeper into this and in the trenches. What Camila said, which I loved, is that these are two huge markets, but they're very different. And both of you, Ralph and Angel, you are building fintechs inside those markets. So I'm curious, and there's no sequence of answers to this question, but what is the one most important tailwind that you see in your country that the other country doesn't have, but could absolutely benefit from? And actually, I want to start with Angel because you already touched on Pix a little bit. It's an obvious one. We'll hopefully come up with another one, but I'm curious to hear what Angel feels.
No, so what's happening in Mexico, that's the complete opposite of what we're seeing in Brazil. Like if you look at like offline retail payments, it's like 80% cash. So cash is king. And as Cami alluded to, the trust barrier that you need to overcome in order to digitize people in Mexico is very relevant. So the way we wanted to overcome that in our go-to-market is through a very simple credit experience at the point of sale. So what we're doing is basically we're democratizing installments. So in Mexico, around 80% of credit card transactions are post-purchase installment plans, very similar to Brazil. But the difference is that in Mexico, only 10% of the population has a credit card. So you have 90% of the population completely disregarded in terms of paying in installments. So what we wanted to do is to create an embedded experience in offline merchants where we're making real-time credit decisions at the point of sale. And the problem there is that the data that is available for the Mexican consumer is very poor. So it's such a data-light market that we're relying mostly on merchant data, on SKU data, in order to make an underwriting decision in less than 3 minutes, 4 minutes. And then after that happens, we are digitizing people. And once we make that experience where we're trusting the consumers rather than the other way around where they trust us, no, we're trusting them that they're going to pay us back. And we're giving them a very nice UX that's very quick, fair, transparent. And after that first transaction is where the wedge starts, where we're trying to cross-sell them to different products, trying to get them to move away from cash and to buy online, offline, through our own rails. Because in Mexico, unfortunately, the government hasn't been as proactive as it has been in Brazil. We don't have that tailwind where you have Banco de Mexico pushing CODI, which is the equivalent of Pix. So it's entirely up to the private sector. So that's kind of all the work that we're doing here. But, you know, it's kind of at the same time like a blessing in disguise because it is giving a new method of payment that hasn't been around in Mexico, and us doing that and obviously spearheading that has helped not just only us, but our consumers and our merchants as well.
In terms of the timing, like what does it specifically mean, like driving this adoption, driving this trust? like giving people the benefit of a doubt from the business perspective, like how long are the cycles in Mexico?
So, giving the benefit of the doubt in Mexico, it's like really challenging because obviously, like I said, many consumers don't have sufficient credit history. In our case, 70% of our consumers have had no credit history before. So our go-to-market really started in focusing in short duration and low average order value, so that basically for every dollar that we're originating, we are taking the least risk as possible by onboarding as many customers as possible. So that way we're building our data set, our proprietary data set, as fast as we can, and we're learning from that. And over the years, we've built our AI models that are been kind of self-learning now. And now we're in a place where basically really depending by the risk signals of not just only the user, but the merchant and the product as well, we're customizing credit offers based on duration, based on loan tenor, based on pricing, so that basically we onboard as many people as we can into the digital system, but taking the least risk as we can, which is usually what hampers companies from democratizing digitized payment solutions, particularly through credit rails.
Well,
if I could add, QED is actually an investor in APLAZO, and the other things that caught my attention when I was looking at how to build that trust is cash is actually everywhere. It's in your wallet, so where you go, you can take the cash and pay. So APLAZO had to be everywhere for the model to kind of work. And if you walk in Mexico City and you look around in the SMEs, you're going to see we accept. And for us, that was a major thing. Why is that? Because if you're doing proper underwriting, you want to know the SKU level of what is that person buying and why does that matter, right? Like you should be doing underwriting very differently. Someone's buying food versus, more of a physical good. So for us, the ability to build trust and build the underwriting that actually scale on the SKU level require them to be everywhere. And to be everywhere in the physical world is quite hard. It's very hard to execute. So in Brazil, you have multiple maquininhas and you have multiple solutions. But in Mexico, you have a lot of large chains that have their own solutions. So really, if you don't have that credit card, your other solution is only cash, because you can have a buy now, pay later line at one of the large supermarkets, but guess what? When you go to the pharmacy, that line doesn't work. So for us, being able to be everywhere, doing scalable underwriting, and everything that Angel said about the risk, duration, and average ticket were things that really caught us attention as a differentiated way to gain trust and scale in Mexico.
We will get back to buy now, pay later, but I was curious, how did the tailwinds that exist in Brazil factor into your go-to-market and scale-up strategy?
I think in one point, Brazil has the same challenge as Mexico. This is give access to credit to the entire population, because still in Brazil, of the lower income groups, only 40% have credit cards. And this is being solved now through, because out of the population of 230 million inhabitants, 160 million are PIX users. And these people that do not necessarily have a traditional bank account, but they have some kind of digital wallet or a digital bank account. And they don't have a credit card maybe, but they can get access to credit through their digital wallet or digital banking app. And the important thing here is that you were talking about underwriting and creating score. You can do this to all these PIX transactions that are happening, because you get all this experience to the purchase behavior. And this is now happening in Brazil. And I think it's very important, because it includes the whole population, and it's a driver of GDP. There are several studies on this, that the digitalization of the population through PIX has a factor of about 280 billion reais of GDP growth until 2028. And for sure, credit is a very, very important part of this growth.
What is the next frontier? What are the developments, the tailwinds, like some maybe less conventional insight that you are excited about that will accelerate the growth even further?
You know, what we are excited about is account-to-account payments, instant payments like PIX, and this is happening in Brazil, but it's also expanding in all of Latin America. Today, Brazil still represents 75% of all account-to-account payments in Latin America. But we see developments in Colombia and Argentina and Uruguay and you know, in all over Latin America, and also beyond Latin America. Now, Asia Pacific is already advanced in this development with QR code payments, which is basically account-to-account payments. And we see that these kind of payments will replace traditional bank transfers, cash payments in the US, like the check payments, and for sure also card payments. And there are studies that say account-to-account payments can add $280 billion to global GDP. So it's a huge potential. And when this becomes more transparent on a global level, I believe that more and more countries will be interested in driving that development. And here comes what we see for us and for our market as an important thing to do is to interconnect these instant payment systems between countries. So it's fantastic to pay with PIX within Brazil, but what happens when I, as a Brazilian, travel to Argentina and want to pay my restaurant bill? I have to use credit card or cash again. I don't want to do that. I want to continue paying as I'm doing in Brazil. And the same thing when an Argentinian travels to Brazil or to any other country. So we believe that these systems are going to be interconnected. In Asia, it is already happening. In Europe, we see the first, like Spain, Portugal, and Italy interconnected their systems. In the Nordics, I was speaking with somebody about that today. There's also interconnection already happening. It's happening in South America, and I think this will be a huge driver of interconnected account-to-account payments. And on top of that, you can build a lot of stuff you cannot even imagine today.
On the BNPL side, buy now, pay later, that is an interesting space because we've seen a fairly rapid growth, and then it went in and out of fashion for quite some time. So from your perspective, like from the framework thinking, what does it actually take to build a sustainable BNPL platform in the market like Mexico, which, like you mentioned, that the credit history and risk in general is fairly high. Credit history is low, but risk in general is pretty high.
Right. So I guess I'll start with like the market size. You know, when you look at BNPL in Mexico and you try to like associate it with BNPL in developed markets, it's complete different narrative. You know, developed markets, it's more like a convenience tool of paying in installments, interest-free usually. And in Mexico, that value proposition is I think, hard to scale. In Mexico, it's more about the credit and giving the credit and accessing and increasing credit penetration. And because of that, you know, the financial conditions in Mexico are way higher than in the United States or in Europe, so interest rates are much higher. So actually the margins that BNPL companies have in Latin America are usually higher than the one in the developed markets. So when you think about like pricing, you know, you get a lot of room for taking risks. And yes, it is true that delinquency rates, for instance, are probably, you know, 3 times higher than a developed market. But it's really just because of 2 things, I would say. Number one, low data. It is the price to learn. But number 2, fraud. Mexico is always ranked amongst the top 3 most fraudulent countries in the world. So tackling that is always super challenging. But I would say between the interest and the fees that these companies are clipping from both the consumer and the merchant, it does give ample room to have sustainable margins. I would say even higher than in developed markets like Europe and the United States. But yeah, I think obviously when you look at unit economics, it's obviously the thing that needs to be present in order for the fundamentals to work and to really start learning. And I would think that like any lending company, you really don't hit the efficiency frontier of knowing who's going to pay and who's not with accuracy after 3 to 4 years. So it is capital intensive in the beginning. So those unit economics need to be in place since the beginning, albeit obviously with an understanding that you're taking more risk in the beginning that you will be 3-4 years down the road.
Follow-on question to you, Camila. So with that in mind, how do you discriminate the performance from sustainable growth, responsible growth, versus subsidized traction? Like, what are the signs that you are looking for in the companies that show long-term sustainability of a business?
So I think we mentioned a couple of them earlier, but looking at the cohorts when you start a buy now pay later business, it's very common for you to see delinquency on that first loan to be your worst cohorts, or it should be if you're doing a good job. And what we try to do is go deeper to say, are you learning on the next loan? And have you built trust for that second request to even come in, right? And then of course, if you can get that same customer to come in multiple times, then effectively you can build a sustainable business. If your initial cohort looks absolutely horrible, then we question whether or not that's scalable, right? Like you expect it to be bad, but also within controllable where you can get second and thirds and fourths, and you don't have what we call a leaking bucket where you just churn so much on the first cohort that you cannot build a sustainable business. For APLAZO, so I think we mentioned earlier, starting with the right size of loan, starting with the right duration where you can learn, and then you really are looking for the second, the third, the fourth loan request. You're also looking for, is that happening on the same merchant, or is that happening in multi-merchants? Is that customer taking your business elsewhere? So you're using that payment method in a merchant where Angel and his team didn't actually have to go there and sell the business themselves. So I think for us, we look at both on the cohort analytics piece, but on the actual go-to-market of, is this becoming a business for word of mouth, which is really going to help the online, offline business kind of take off. And we looked at, I actually talked to them and passed on the round prior that we did. And the amount that they learned and tested between those 2 rounds was incredible. They diversify SKUs, they diversify type of stores. It was extremely hard to do, because that's the other thing. You look some buy now pay later companies, they do the same loan for the same type of companies, copy and paste. And it's very hard once you add a different SKU to get that portfolio to behave in the same way, because you have different incentives of repayment, you have different average tickets. So those are the things that we try to look at. It is a thesis that globally we've been more on the negative side. And you know, everything that we learned over the years, we saw his team working on it, testing the right way, and we got extremely excited and joined them on the last round. I think for Brazil, the one thing that we didn't talk is alignment of incentive. So if you look at Brazil with Pix recurring, with all the different payments technology that's coming in to disrupt the traditional buy now pay later model, the traditional credit card model, how do you really align incentives so that merchant is going to look at you as, this is the best credit, I'm going to send the best credit to you? Because as you said, right, like you can be a buy now pay later providing Brazil, but you're the 4th option. After everyone else declined, you're pushing volume that way. So I think for us, the other thing was, how is APLAZO, positioned in Mexico? But we look at in Brazil, how are players positioned on aligning on this incentive? And there are a couple companies building quite interesting solutions. A regulatory change happening in Brazil where any person can now invest in FIDICs. So we see some companies trying to experiment where the merchant can actually become an investor on their own FIDIC. So they have incentives of upside and downside, therefore aligning incentives. So I think we're seeing a couple change of behavior in Brazil as, Pix changes up how everything works. But for us, everything that Angel said, plus the aligning incentive, is kind of what makes that model stay on its own.
Ralph, on your side, from the founder's perspective.
Yeah, from our perspective, my company is a bootstrapped company. We never took capital, so we always had this situation that we had to innovate. We had to aggregate value. We could not buy the market, never, because we had to turn around 3 times every dollar we would spend. And this created a DNA in our company that is totally focused on adding value. And this is throughout the whole company, from development, product, down to sales. Now, nobody in our company comes to me and asks me, "Ralf, we have to lower the price to make this sell." It doesn't exist. We always try to create value. And also to escape from competition. This is very important, as you said that, to create new things, different proposals, not Me Too stuff, that everybody does the same. We never did that, and when we see that something becomes like market standard, we either try to add something on top that innovates and creates even more value, or we just say, okay, that's not a focus product anymore because we don't aggregate value for our customers, which our customers are merchants, and so we don't aggregate value for our merchants, and we stay away from it and focus on other things. We always innovate, and it's a stressful thing. My co-founder and I, our company is 15 years in the market, and we say we can never lay down in a hammock. We always have to run, and like Andy Grove, the founder of Intel, said, only the paranoid wins. And this is a bit the feeling you have if you're in fintech business in Brazil. It's really highly competitive, and you have to innovate all the time to stay on top.
You mentioned something before. You were talking about that expanding across LATAM and FX controls. It's like it's a huge maze right now. So I have a conceptual question for you guys from the founder's perspective and you, Camilla, from investor's perspective. Because right now, to be a sustainable business, you got to optimize for being at least a regional player, right? You cannot bear the single country risks forever. So with that context, how do you think about building a business that is right now might be a single market business, right? But is scalable into a regional or global player in the space, given all of the constraints and FX compliance regulation? How do you conceptually think about it?
Should I start? First of all, Brazil is a big country. Brazil is 200, as I said, more than 200 million inhabitants, and it's by far the biggest market in Latin America, especially when it comes to digital solutions, fintech companies. And I believe the market is big enough for a company to survive only in that market. And even I'm surprised. Now, if you look at POS devices, for example, we say, look, this is a Me Too product per se. Now, already have huge volume, or forget it. But still, you have regional players that in the north of Brazil, in some regions, they somehow add value in this specific space, and they're profitable companies. So I would not say that in general you cannot do it, but for sure, if you want to have a business where you really want to scale large, you have to at least cover a number of countries. And the smaller the country is now, if you have a product like a company in Paraguay or Uruguay, then it's really, really difficult. And what we see, and this is also the reason that most of the successful companies in Latin America, and they are successful in Brazil. And even the companies that they start in Colombia, they have a fantastic product, but they scale in Brazil. This is the way to go. Or they start in Brazil, or they go to, at some point, they do a proof of concept in their countries, and then they go to Brazil and scale in Brazil. I think this is the way to go in Latin America.
I think from my point of view, Mexico is obviously a big country as well, but the way we like to think about it is growth adjacencies that unlock addressable market and minimizing execution risk as much as possible, because launching a new country carries enormous amount of risk, different cultural behavior, different data sets, different purchase channels, a whole different mix of ingredients that just were not present in Mexico. And the way we're thinking about it is, so we started with low average order values, so fashion, clothing stores, general merchandise stores, but we have so many growth adjacencies and expanding across different subsegments within the retail market, like electronics, furniture stores, entertainment. So these are all growth adjacencies that we haven't unlocked that I think it's very applicable to many fintech businesses that are operating under one country. It's like the question you got to ask yourself is, how do we keep opening new addressable markets that add to the TAM, but without having to take a huge risk of launching a new country or even a new product. So before we do that, we're still I would say 3 years from launching a new country. So it's not something we're thinking about proactively, but that's the way we're thinking about it.
You got to crack the first market first. Unfortunately, I think what Camila thinks about building a global company by default, we will have to take behind the scene. Thank you so much, guys, for a very insightful conversation. Thank you.
Thank you.
Thank you. I won't